If you're self-employed and looking to get a mortgage, you might be a little fearful because you hear all these horror stories of people not being able to get approved for a mortgage because they're self-employed. Well, I'm going to walk you through two different ways, two different types of loans you can use to get approved for a mortgage if you're self-employed. It's really not that difficult. My name is Kyle with winthehouseyoulove.com. Let's go ahead and jump into this. So how do we get approved if you are self-employed? All right, so maybe you own a company, whether that looks like an LLC or a corp, and you are trying to get a mortgage here. So why in the world is this income even different from a regular employee? So the main reason why your income as a self-employed buyer is different than somebody who's like a W-2 employee is because a lender actually takes on more risk. They view self-employed buyers as riskier than regular employed buyers. And that's because lenders want stable, consistent income. All right, so when somebody works for a company, normally that income is viewed more consistent than somebody who's self-employed because they have a company that usually is providing a paycheck, and there's the assumption that that company is doing well. All right, that's just an assumption that lenders take. But when you're self-employed, lenders don't usually take that assumption. Their assumption is you own that business or the majority of that business, and they need to make sure that not only are you underwritten, but the business is also able to provide cash for you in the future to pay that mortgage down. So they use what's called the ability to repay rule. That basically says lenders have to look and see, can you actually afford this mortgage? Can you pay it back based on everything that they're looking at? And they can only consider taxable income. So this is where self-employed buyers get into a little bit of trouble, is because maybe this year you made $100,000 personally, but you wrote off, I see some people write off maybe $60,000 worth of that. So to the lender, you only made $40,000. They can't take $100,000 as your income because you said that you had $60,000 worth of expenses. So that's why it can be a little tricky, is because you have a lot of deductions and income might be fluctuating depending on seasonality or depending on the different years. And most likely, if you're self-employed, your income is probably trending in a specific direction. Hopefully, it's going up each year, but it's possible that it's going down as well, just due to the nature of self-employment. So something that you'll want to know is that self-employed buyers need to have a minimum 2 years of being self-employed. So if you were at a W-2 job last year and you just flipped to a new self-employment work this year, you're not going to be able to get a loan. You need to be self-employed for 2 years. No matter what your income looks like in that range, you need to be working self-employed for 2 years to be able to qualify for a mortgage. And the reason why is because lenders want to see that you have a longer history of employment, that you're working consistently, and they also want to see income that's consistent. So there's going to be two different types of loans that you're going to run into. You're going to run into a traditional loan and a portfolio loan. We can call these like a niche product, or we can use interchangeable language in here. But these traditional loans are just your regular loans, things like conventional loans, FHA, VA, USDA, kind of the big four main loans that you see. These are the loans that regular people get, those types of loans. These niche portfolio loans are things that allow you to not have to show your tax returns, and they use alternative documentation to prove your income. So let's talk through what that looks like here in just a sec. So, okay, let's first talk about traditional loans. Again, traditional loans are our things like conventional, USDA, FHA, and VA loans. So when we're qualifying with one of these loans, our write-offs are going to have a huge impact. Again, so if we made $100,000 this year, but we wrote off $60,000 worth of expenses, our net is only going to show $40,000. So now I can only qualify with a loan using a $40,000 income. That dramatically changes how much I can qualify for. So if you have write-offs, those are going to be impacted pretty greatly on your mortgage because the lender only wants to look at your net income and not the gross income. And there's no way to get around this using a traditional type of loan like conventional FHA, USDA, or VA. They have to look at net. There's no option around that for these types of loans. Also, they're going to require 1 to 2 years of personal and possibly business tax returns. All right, I know it can be scary to have a lender look at these, especially if you're thinking I might not have enough income on there. But when you work with a lender, it should be a collaborative experience, not something that you're afraid of. So what I would suggest is have these documents ready up front, show them to the lender and say, hey, I don't know where I'm at, but I need some help exploring what can I qualify for? What do my tax returns show as far as the income that I could use on my loan? So get those documents up front. Most of the time, you'll just need the personal. Sometimes you'll need the business tax returns as well. It kind of depends on the loan program and how you're setting up your loan there. But your loan officer should be able to walk you through what that looks like. Also, you might be asked for profit and loss forms. So this might be included when they ask for your business tax returns. So they want to see the viability of your business, especially if it's a sole proprietorship or you have majority stake in the company. They're probably going to want to look at profit and loss to see the trend and cash flow of your business year over year. All right. Also, when you get these loans, they're going to be at just the regular interest rate that anybody else would get. So a lot of times I hear self-employed buyers feeling like they're going to get charged a higher interest rate because they're self-employed, which isn't true. If you are able to qualify for a loan with your write-offs, or maybe you don't have a lot of write-offs, if you can qualify for one of these loans as a self-employed buyer, then absolutely you'll get the same interest rate that every other employee, W-2 employee would get on a conventional FHA, USDA, or VA loan. So let's say that your write-offs are too high and you don't have enough net income to show for how much income you actually make, right? So maybe in this example, you do make $100,000 a year, but you wrote off $60,000. So you need to be able to qualify with $100,000. So the way that you do that is through a portfolio loan. Traditional loans are going to be mainly for if you can qualify on your net. Portfolio loans are going to be if you need to qualify on your gross. Okay. So there are two main types of portfolio loans. One is a bank statement program. Sometimes people call this stated income. Stated income used to be a thing before the housing crash happened and doesn't exist anymore because we had the housing crash and they were like really bad loans. A stated income loan would be where someone would walk in and say, hey, I make $100,000 a year. And the bank would say, that sounds great. Here's a loan. And it doesn't work like that anymore. Some people are renaming bank statement programs as stated income, which isn't true because bank statement programs still look at income. So a bank statement program is where instead of showing your tax returns, a lender asks for your past 12 to 24 months bank statements. And then what they do is they average the deposits over the past 12 to 24 months and give you an income. So that's how they decide the income. You might be able to use personal bank statements, or you could use business bank statements. Normally with business bank statements, they use a factor of 50% expense ratio. So if in your business expenses, or if you're in your business bank account, let's say over the past 12 months, you earned $200,000, the lender would cut that in half and say you earned $100,000. If it was your personal bank statement and you had $100,000 deposits, they would use $100,000 as your income. So it can be a little tricky. Again, talk with the lender. They'll help you do all the math here. So you have bank statement programs. You also have 1099 programs. These are a little bit newer. A 1099 program is where a lender would just look at your past year or past 2 years 1099s, and then they normally use an expense factor on that as well. So normally what I've seen is an expense factor of 10%. So what they would do is take your 1099 from last year. Let's say last year you made $100,000 on a 1099. They would take 90% of that as your qualifying income. So they would say you made $90,000 in qualifying mortgage income. All right, portfolio programs have a little bit of a downside though. Normally they need about 15% down or higher. These traditional products, USDA is 0% down, VA is 0% down, FHA is 3.5% down, and conventionals 3% down. So 15% down can be a little bit tight. You also need good credit. Normally, you're going to want to be in like the mid to higher 600 score range, somewhere around a 660 to a 680 and higher. Again, most of the time it's going to be 12 to 24 months bank statements averaged. And something that you're going to run into, no matter what portfolio program you use, is it's going to have a higher interest rate. So, and it can be pretty high, honestly. So if a traditional loan, let's say a traditional conventional loan, I'm just going to say if the interest rate right now was 3.5%, with a portfolio loan, you're probably looking closer to a 5 to 7% interest rate. They're just going to be a lot higher because they are riskier, because they're keeping those loans in a house. They're usually not going to be able to sell them on a secondary market to Fannie Mae or Freddie Mac like you can with a traditional loan. And they work well if you need them. I would always try to go with qualifying for a traditional loan if possible, because the portfolio loans just are a little bit more expensive. So some things to consider. Number one is you don't want to be tax blind when you're going into this process. So a lot of people who are self-employed, I get it. You're already working a ton. You're managing a business. You're doing the things in your business. You're managing employees and orders and everything that needs to go on with you setting up your business. The last thing you want to do is worry about taxes. So most of the time, business owners have their taxes prepared by somebody else. And the accountant normally is trying to help you. They're trying to say, hey, I want to get all these deductions for you so you save money in taxes. And you think, great. But the flip side of that is when you write off all this stuff on your taxes, you might not be able to qualify for a mortgage. So don't be blind when you're having your taxes done. Something you can do is talk with a lender and say, hey, I want you to take a look at my taxes, see what they look like right now. Get that advice before you then file your taxes for the upcoming year. That way you can see, is there anything that I need to change? Maybe do I need to hold back on some of the deductions that I'm putting in my tax return so that I can qualify for a mortgage? So it's something to be mindful of. A lender can help you take a look at what you can qualify for with. An accountant, their job is to help you save the most money on taxes. A lender's job is to help you qualify for a mortgage. And they're kind of working against each other at that point. So talk with both and see if you can come up with a remedy that's going to help you qualify for a mortgage if that's what you're looking for in the near future. Another consideration is if you can't qualify for a traditional loan and you really don't want to go with a portfolio loan, one option is to add a non-occupant co-borrower or co-signer. It's the same thing. Basically what happens is you would be the primary borrower on the loan and you would have somebody co-sign for you who won't live in the property. So this is a great option. I've done this with several people who have been self-employed. We had trouble documenting income and they didn't have a down payment. So we added a co-signer, and that co-signer basically said, yep, I'll sign up to show my income and credit on this loan and guarantee that it gets paid. So that is one option if you have that available to you. Down payment for that is about 5% down minimum most of the time. So it really is a great strategy to then use that and then maybe refinance. What I always suggest in this strategy is keep this loan and then the buyer who's self-employed to then eventually refinance into a traditional loan so that the co-borrower can get off of that because a co-borrower normally doesn't want to be on a mortgage for very long. Another option is use a niche program, use a bank statement program, and then refinance into a regular traditional loan after you maybe file taxes one more year with less deductions. So overall, if you're self-employed, it's not the worst thing in the world to go through the mortgage process. It's going to be more documentation for you. It might be slightly more stressful and might be a little bit longer of a process, but find a lender who's willing to collaborate with you and help you through understanding what can you qualify for and what steps do you need to take if you don't qualify for the program that you want right now. If you have any questions, let me know, but thanks so much for watching.